This video is a brief analysis that examines the transmission mechanisms through which the United States national debt and fiscal policy affect countries that peg their currencies to the dollar or consider full dollarization. As the U.S. gross national debt surpassed $38 trillion in late 2025, with debt service costs approaching $1 trillion annually, the implications for emerging market economies become increasingly significant. This analysis explores how U.S. inflation erodes the purchasing power of foreign dollar reserves, how Federal Reserve interest rate decisions create capital flow volatility, and how dollar hegemony creates an asymmetric relationship that transfers fiscal risk to peripheral economies. The case of Ecuador and Argentina provides a particularly instructive example, given its historical experience with currency pegs and current debates surrounding dollarization. The article argues that countries considering dollar pegs must weigh not only domestic monetary stability, but also their exposure to U.S. fiscal decisions over which they have no control. Policy recommendations emphasize the importance of understanding inherited risks, building foreign exchange reserves, and developing diversified currency strategies. Strategic negotiations and contracts. The United States dollar occupies a unique position in the global financial architecture. As the world's primary reserve currency, the dollar accounts for approximately 60% of global foreign exchange reserves and facilitates roughly 40% of international trade settlements. International Monetary Fund, 2024. This dominance, established in the aftermath of World War II and reinforced through the Bretton Woods system and its subsequent evolution, confers what French President Charles de Gaulle famously termed an exorbitant privilege upon the United States. However, this privilege carries significant implications for the many nations whose economies are linked to the dollar, whether through formal currency pegs, dollarization, or de facto dollar dependence. As of December 2025, the United States gross national debt stands at approximately $38.4 trillion, having increased by $23 trillion over the preceding year alone. Joint Economic Committee 2025. The Budget Reconciliation Law enacted in July 2025 raised the statutory debt limit to $41.1 trillion, signaling continued fiscal expansion. Congress.gov 2025. Interest payments on this debt have nearly tripled over the past 5 years, reaching $981 billion in the 12 months ending October 2025. These developments raise critical questions for countries whose monetary policies are tied to the dollar. What risks do they inherit from U.S. fiscal decisions? How does U.S. inflation affect their economies? And what policy options exist for managing these exposures? This article addresses these questions with particular attention to Argentina, a country that has experienced repeated currency crises and currently debates the merits of full dollarization. Argentina's historical experience with currency pegs, most notably the convertibility plan of 1991-2002, provides valuable lessons about both the benefits and risks of linking monetary policy to the dollar. By examining the transmission mechanisms through which U.S. debt and monetary policy affect dollar-pegged economies, this analysis aims to inform policy discussions in Argentina and similar emerging market contexts. The structure of U.S. national debt. Understanding the impact of U.S. debt on foreign economies requires first examining the structure and trajectory of that debt. The U.S. national debt comprises two main components: debt held by the public, consisting primarily of Treasury securities sold through auctions, and intragovernmental debt, which represents holdings by federal trust funds such as Social Security and Medicare. As of September 2025, debt held by the public stood at approximately $30.3 trillion, while intragovernmental holdings totaled $7.4 trillion. Government Accountability Office 2025. The pace of debt accumulation has accelerated significantly in recent decades. The Congressional Budget Office 2024 projects that federal debt held by the public will rise from 99% of gross domestic product in 2024 to 122% by 2034, surpassing the previous historical high of 106% recorded during World War II. Several factors drive this trajectory. An aging population that increases mandatory spending on entitlement programs, rising healthcare costs, and, most significantly for this analysis, growing interest costs that consume an increasing share of federal outlays. Interest on debt held by the public increased 83% between fiscal years 2022 and 2024, from $497 billion to $909 billion, GAO 2025. For countries holding dollar reserves or pegging their currencies to the dollar, these developments carry direct implications. When the U.S. government finances deficits through debt issuance, and when the Federal Reserve accommodates this through monetary expansion, the resulting inflation erodes the real value of dollar-denominated assets held abroad. Countries that have accumulated dollar reserves as insurance against currency crises find that this insurance gradually loses its purchasing power. Transmission mechanisms from U.S. fiscal policy to emerging markets. The inflation channel. The most direct mechanism through which U.S. debt affects dollar-pegged economies operates through inflation. When the United States runs persistent fiscal deficits, it faces three primary options: reduce spending, increase taxes, or allow inflation to erode the real value of the debt. Political economy considerations often favor the third option, as inflation represents a diffuse and delayed cost that is less visible than explicit fiscal adjustments. Federal Reserve Bank of St. Louis 2023. The U.S. dollar has lost approximately 96% of its purchasing power since the Federal Reserve's creation in 1913, Bureau of Labor Statistics 2025. While this decline reflects the normal functioning of a fiat currency system where money supply expands with economic growth, it nonetheless represents a gradual transfer of wealth from holders of dollar-denominated assets to the issuer of those assets. For countries that peg to the dollar or dollarize, this means they import not only U.S. monetary discipline, but also U.S. monetary erosion. The implications become more acute during periods of elevated inflation. Between 2021 and 2022, the purchasing power of the dollar declined by approximately 7.4%, Bureau of Labor Statistics 2023. For a country holding $50 billion in dollar reserves, this represents a real loss of $3.7 billion in purchasing power in a single year. Such losses compound over time, meaning that the inflation insurance provided by dollar reserves is itself subject to inflationary erosion. The interest rate channel. Federal Reserve monetary policy decisions ripple through global financial markets with particular force in emerging economies. Research from the Federal Reserve Bank of Kansas City 2023 documents that higher U.S. interest rates are historically associated with capital outflows from emerging markets, currency depreciation, and increased financial vulnerability. This pattern reflects the dollar comes home effect. When U.S. rates rise, global investors reallocate portfolios toward dollar-denominated assets, withdrawing capital from emerging markets. The 2022-2023 Federal Reserve tightening cycle, which saw the federal funds rate increase by 25 percentage points, represents the fastest tightening since the early 1980s. Federal Reserve Bank of Dallas, 2023. Historical precedents for such aggressive tightening include the 1979-1980 Volcker disinflation, which preceded the Latin American debt crisis, and the 1994 rate increases, which contributed to the Mexican peso crisis and subsequent Asian financial crisis. As Kalemlios Khan and Unsal, 2023, documented in their Brookings Institution research, Fed tightening has historically triggered sudden stops in emerging markets, where capital flows abruptly reverse. For a fully dollarized economy, this channel operates with full force. The country imports U.S. monetary policy decisions without any ability to calibrate them to domestic economic conditions. When the Federal Reserve raises rates to address U.S. inflation, the dollarized economy experiences tighter credit conditions regardless of whether domestic circumstances warrant such tightening. Conversely, when U.S. conditions call for monetary easing, the dollarized economy may experience inappropriately loose policy. The Sattiraju channel Sattiraju refers to the profit a government earns from issuing currency, representing the difference between the face value of money and its production cost. As noted in analyses of dollar hegemony, a $100 bill costs approximately 17 cents to produce, yet it commands $100 worth of goods and services. Xinhua, 2023. Estimates suggest that U.S. Sattiraju revenue from dollars held abroad amounts to approximately $20 billion annually. National Affairs, 2024. When a country dollarizes, it transfers this Sattiraju privilege to the United States. The dollarizing country must acquire U.S. dollars by exporting goods, attracting investment, or borrowing, all of which represent real resource transfers. Once dollarized, the country cannot create money to finance government operations or respond to financial crises. The Federal Reserve, meanwhile, continues to collect Sattiraju on the expanded use of its currency. This asymmetry has led analysts to describe dollar hegemony as imposing significant costs on developing and emerging market economies. Cambridge University Press, 2024. The Argentine Case. Lessons from History and Current Debates. Argentina provides perhaps the most instructive case study for understanding the implications of dollar linkages for emerging economies. The country's experience illuminates both the potential benefits of currency stability and the profound risks of surrendering monetary sovereignty. The Convertibility Plan, 1991-2002. In 1991, Argentina implemented the Convertibility Plan, establishing a one-to-one peg between the peso and the U.S. dollar. The plan initially succeeded in ending hyperinflation, restoring economic stability, and attracting foreign investment. However, the rigid currency system stripped Argentina of monetary policy flexibility, leaving it vulnerable to external shocks. Federal Reserve Bank of Chicago, 1999. The system's fragility became apparent during the Russian and Brazilian crises of the late 1990s, which eroded Argentine export competitiveness and triggered capital flight. The fixed exchange rate, combined with fiscal pressures, created an explosive debt dynamic. By December 2001, Argentina defaulted on $95 billion in sovereign debt, then the largest default in history, Fair Observer, 2025. The subsequent collapse of the currency peg demonstrated that borrowing stability from the dollar comes with inherited vulnerabilities. Current dollarization debates. President Javier Milei's election in 2023 reignited debate about full dollarization for Argentina. The proposal emerged against a backdrop of 201% annual inflation, deep distrust in the peso, and decades of monetary mismanagement. Michigan Journal of Economics, 2024. Proponents argue that dollarization would eliminate the central bank's ability to monetize fiscal deficits, thereby imposing discipline that Argentina's institutions have failed to achieve domestically. However, critics note that dollarization would mean putting Argentine monetary policy in the hands of the U.S. Federal Reserve. Cato Institute, 2024. The Federal Reserve, focused on U.S. economic conditions, would set interest rates independently of Argentina's economic volatility. This creates particular risks for an economy heavily dependent on commodity exports, where price fluctuations can cause significant terms of trade shocks requiring monetary policy flexibility. The Peterson Institute for International Economics, 2025, observes that Argentina remains hostage to shifting investor sentiment because of its heavy reliance on the dollar. The October 2025 crisis, triggered partly by political scandals, demonstrated this vulnerability. Dollar reserves hemorrhaged as investors fled, and the government required emergency intervention to stabilize markets. This pattern, where domestic political events interact with dollar dependence to create financial instability, represents a persistent feature of Argentina's economic landscape. Policy implications and recommendations. The analysis presented above suggests several policy considerations for countries contemplating dollar pegs or dollarization, as well as for those already operating within dollar-linked frameworks. First, countries must recognize that dollarization or tight dollar pegs do not eliminate monetary risk, but rather transform it. Instead of bearing the risk of domestic monetary mismanagement, the country assumes exposure to U.S. fiscal and monetary decisions. Given current U.S. debt trajectories, with debt-to-GDP ratios projected to reach 122% by 2034 and interest costs consuming an ever larger share of the federal budget. This exposure carries meaningful long-term risks. Second, reserve adequacy becomes critically important. The Guidati-Greenspan rule suggests that countries should maintain foreign exchange reserves sufficient to cover short-term external debt plus 12 months of current account financing needs. Federal Reserve Bank of Dallas, 2023. For countries considering dollarization, this buffer becomes even more essential, as no domestic lender of last resort exists to provide emergency liquidity. Third, fiscal discipline remains a prerequisite for any currency arrangement to succeed. Dollarization removes the ability to monetize deficits, but does not eliminate the underlying political pressures that generate those deficits. As the Michigan Journal of Economics 2024 notes, fiscal decisions made at home will need to match that rigidity for USD adoption to work successfully. Fourth, countries should consider diversification strategies that reduce singular dependence on the dollar. This may include building reserves in multiple currencies, developing local currency debt markets that attract foreign investors, and strengthening regional trade arrangements that reduce dollar settlement requirements. The gradual decline in the dollar's share of global reserves, from over 70% in 2001 to approximately 59% in 2024, suggests that such diversification is already occurring at the global level. J.P. Morgan, 2025. Conclusion. The relationship between U.S. national debt and dollar-pegged economies reflects a fundamental asymmetry in the international monetary system. The United States, as issuer of the world's reserve currency, can run persistent deficits financed by global demand for dollars. Countries that peg to the dollar or dollarize import both the stability benefits of that anchor and its inflation and policy risks. For Argentina, the dollarization debate must be understood in this context. While full dollarization might eliminate the peso's chronic instability, it would also mean permanently surrendering monetary sovereignty to an institution, the Federal Reserve, whose mandate focuses exclusively on U.S. economic conditions. The $38 trillion in U.S. national debt, growing at over $6 billion per day, represents a fiscal trajectory that may eventually require either significant adjustment or inflation to resolve. Countries tied to the dollar will share in the consequences of that resolution. This analysis does not argue that dollarization is never appropriate. For some small, open economies deeply integrated with the United States, the benefits may outweigh the costs. However, it emphasizes that the choice involves trading one set of risks for another. Policymakers and citizens in countries considering such arrangements deserve a clear-eyed assessment of both what they gain and what they inherit. The dollar's status as the world's reserve currency is not immutable, and the fiscal path of its issuer warrants careful attention from all who depend upon it. Thank you for watching. Subscribe, like, and share.